Hello, accounting students. Today we're going to be talking about business transactions. What's really important to understand about business transactions and kind of really how they fit back to the balance sheet or the statement of financial position is, I guess the best way to explain it is kind of comparing it to a picture. So if you see a boat, maybe on a lake or a river or something, and you see people on the boat, if you take a picture of that boat and those people, it is kind of that picture represents that boat and people fixed at that point in time. The minute there's any little bit of current in the stream, or they move around, the people move around on the boat, or the wind blows the boat up or down the stream, then suddenly that picture, it doesn't exist anymore. It's past, it's moved along. Well, the same thing is true of a balance sheet. It is a representation, a numerical representation of a business at a given point in time. And in fact, back in the day, where on the date line, they used to actually put in the words as at to remind people that that financial statement exists only at that particular point in time. Because as soon as even one more transaction takes place, it will be a different balance sheet. So for instance, in this case, we have a balance on the cash account of $2,500, and we have a balance in the office supplies of $5,000. So supposing we went out to Staples the day this was prepared, and we bought $500 worth of office supplies to put in our store or our business. Well, I'm sure you can figure out that if we would pay cash, so we would have $500 less cash, and we would therefore have $500 more worth of supplies, even though our final totals wouldn't change because it's kind of a net difference of zero. Our office supplies and our cash account are now different since that balance sheet was taken. And so therefore, that statement of financial position that was first prepared is no longer valid. And so that's why it's really helpful to think of the balance sheet as an actual picture of a company. So moving ahead then, a little bit of information or background around transactions. By the way, transaction is a really long word to always be typing and writing, so I use TXN or transaction as a short form. By definition, this is a financial, so money-related event that causes a change in the financial position of a business. So anything related to money, some simple things like paying bills or putting money into the business, ordering stock to sell, like we're talking about like goods that you sell in your business, inventory, equipment, factories, anything like that, taking out a loan, taking payments from customers, making payments to creditors. All these things are financial related and therefore affect the financial position of the company. Now, on the other hand, things that wouldn't be included might be like inspection reports, so like a health inspector or an electrical inspector. If we received a notice from the federal government that we were going to be audited, if we were served legal note papers from maybe a customer or something, all these kinds of things would not be included, as they are not immediately anyway finance related. They may become finance related in the future, and then we'll worry about it then, but they're not financial related at this point. Now, what's really important to understand about this process is that we are using the objectivity principle. This is a new accounting principle that relates to the area of processing transactions. This principle requires that whenever we do an accounting transaction, whenever we do anything finance or bookkeeping or accounting related for a business, we're going to make sure that there's some kind of a true record of it. Now, it may be an electronic, it may be a paper hard copy, but there is some kind of objective or third-party record of it. I'm sure you can understand if you've ever played broken telephone, or if you've heard, the rumor mill around school about certain things. Taking things on word of mouth is a real recipe for disaster. And so we try very, very hard not to do that any more than we have to. In fact, like 99.99999% of the time, we're always going to have a transaction record of it. These records are called source documents. And the federal government, federal law actually requires that these source documents be even kept for certain amounts of time. So, for instance, receipts might have to be kept for 2 years. Certain your tax receipt or returns that you do or that your parents do, they have to be kept for 7 years. Banks have all kinds of financial records that they have to keep. So if you made a deposit, for example, they have to your bank account. They have to keep records on hand for at least 2 years. So very important. Um, so by definition, a source document is some kind of business paper, although these days electronic ones are becoming more and more common. That is kind of the original record and provides all the basic information that you would need to process the accounting for the or do the accounting for the transaction. Um, this key information would include usually the amount, the date, who the payee is, so who is making the payment of money or committing to paying money in the future, who the provider of the service is, that sort of thing. Source documents can kind of come in all kinds of forms. The most common that you would come across is maybe like a receipt from a store, a grocery store. Might be a receipt from an ATM when you make a deposit. It can also include other business documents like recaps for money brought in, slips of paper printed by the cash register, bills, checks, even a memoranda. So if, for instance, the owner of the business wanted to withdraw money from the business, and they're totally allowed to do that. They can't just show up at the accountant's desk and say, hey, give me $50. They have to go through a proper accounting process and provide you with a piece of paper authorizing it with their signature on it. And then in return, you would most likely give them a check that they could cash. And then, as I mentioned earlier, all of these records have to be kept on file for future reference, usually by law for certain periods of time. Here is a very simple example of a source document. It's a receipt. Part of accounting is knowing who you're the accountant for. So in this case, if you're the accountant for Quick Auto, this is a sales receipt. So you've provided some kind of a service or a product as Quick Auto, but because we're on the selling side. But if you're Jane Smith down here who signed it, this is actually a purchase receipt to her because it's something that she is buying or paying for. But as I said, it has all the regular information that you would expect to see, and maybe you didn't think about it very much, but it's all very important. So like the total amount, how much you're being charged, the taxes involved, which we'll learn about how to account for that at some point this semester, dates, all that kind of stuff. Now, two very, very, very important things about processing transactions. First of all, there are always, always, always two components to every transaction. And those two things are what is exchanged or what was exchanged and how it was paid for. The other thing that you'll always see is that there will always be at least two accounts affected. So by an account, I mean like the bank account, an account receivable, a loan, bank loan, a mortgage payable, the owner's equity. All those things are individual accounts. And so you will never, ever have a transaction where only one account is affected. And there is a reason for that. And that's the balancing process, which we're going to see about in this lesson.